Imagine placing $100,000 into a mutual fund today, and then letting time and compounding interest take the wheel. Compounding is often called the eighth wonder of the world for a reason. It has the power to turn modest beginnings into substantial wealth when given enough time. Let's break down exactly how an investment like this can grow, especially when earning an average annual return of 8%. Let's start by understanding how compounding works. When you invest in a mutual fund and it generates returns, those returns are automatically reinvested. You don't just earn interest on your initial investment, you earn interest on your interest, and that cycle continues year after year. Over time, this snowball effect can turn a single lump sum into an impressive portfolio. So, what happens to your $100,000 over different time horizons? Let's take a look at the numbers. After 10 years at an 8% annual return, your $100,000 would grow to approximately $215,890. This more than doubling of your investment in just a decade highlights how powerful compounding can be, even when you simply let your money work for you, untouched. If you continue to let that money grow for 15 years instead of 10, your investment would reach about $317,270. Notice how the pace of growth accelerates. The difference between 10 and 15 years is not just an extra $50,000, but over $100,000 in additional growth. That's the compounding effect magnifying your returns as time goes on. Now, let's stretch the horizon to 25 years. After 25 years of compounding at 8%, your $100,000 investment becomes a staggering $685,084. That's nearly 7 times the original investment, all thanks to patience and the power of reinvested returns. But what about hitting a true milestone, reaching $1 million? With an 8% annual return, your portfolio would reach the $1 million mark in about 30 years. 30 years might seem like a long time, but consider, your money would have grown tenfold without any additional contributions. This is the essence of long-term wealth building. Let's break down why mutual funds are such effective vehicles for compounding. Mutual funds typically invest in a variety of stocks, bonds, or other assets, spreading out risk and providing access to professional management. When you reinvest the dividends and capital gains paid out by the fund, every dollar you earn is put back to work, buying more shares and generating even more returns. Over the years, this consistent reinvestment is what supercharges your portfolio growth. Long-term investing isn't just about maximizing returns, it's about reducing risk. Over short periods, markets can be volatile, but history has shown that, over the decades, the market tends to rise, and temporary downturns are eventually outweighed by the power of compounding growth. That's why staying invested for the long haul is one of the most reliable ways to build wealth. So, how does this all fit into wealth building, retirement planning, and financial freedom? Think about retirement planning. If you start with $100,000 and let it grow for 25 or 30 years, you could be looking at a nest egg approaching $1 million. This could provide a foundation for a comfortable retirement, supplementing other income sources like Social Security or pensions. The earlier you start, the greater the impact. Waiting even a few years to invest means missing out on years of compounding growth. Wealth building is not just for the wealthy. It's accessible to anyone with the discipline to save and invest consistently. The key is patience and persistence. By choosing a diversified mutual fund, reinvesting your earnings, and resisting the urge to cash out during market downturns, you give yourself the best chance to harness the full power of compounding. Financial freedom is the ultimate goal for many investors. It's the point where your investment income can cover your living expenses, freeing you from the need to work for a paycheck. Reaching this milestone starts with understanding the math of compounding and making a commitment to long-term investing. Let's recap the numbers one more time. After 10 years at 8%, your $100,000 becomes $215,092. After 15 years, that grows to $318,270. Stretching to 25 years, you reach $685. And at the 30-year mark, you cross the $1 million threshold. These are the tangible results of a solid investment strategy, patience, and compounding interest. Whether you're just starting out or planning for retirement, these numbers show that time is your most valuable asset. The sooner you start, the more your money can work for you. But how do you maximize the benefits of compounding? Start by investing early, even if you can only contribute a little at first. Stick with a diversified mutual fund to help manage risk and capture long-term growth. Reinvest all dividends and earnings, so every dollar is put to work. Most importantly, stay the course. Don't let short-term market swings derail your long-term plans. It's also important to review your investment strategy periodically. As you get closer to retirement, you might want to shift into more conservative funds to protect your wealth. But in the early years, focusing on growth and compounding can set you up for success. Remember, building wealth isn't about timing the market. It's about time in the market. Every year you stay invested gives your portfolio another chance to grow exponentially. The magic of compounding doesn't happen overnight, but over years and decades, the results speak for themselves. Whether your goal is a comfortable retirement, financial independence, or simply growing your savings, understanding and harnessing the power of compounding with mutual funds can help you achieve it. $100,000 invested wisely can become much more than you might expect, turning dreams of financial freedom into reality. Stay informed, stay consistent, and let the power of compounding work for you. Investing isn't about getting rich quick. It's about building wealth steadily and allowing time to be your greatest ally. Start today, and you'll be amazed at how far your investment can go.